I want to talk to you today about paying points or not paying points, because that's a question that I often get. So first thing is, what is a point? Point is a unit of measurement that just basically means 1% of the loan amount. So if you have a $300,000 loan amount and you want to pay 1 point to get a lower rate, that's going to be $3,000. If the loan officer quotes you half a point to get a lower rate, then it's going to be half of 1%. If it's $300,000 loan, you're paying half a point, that's going to be $1,500, so on and so forth. So you can do measurements as little as like an eighth, sometimes less than an eighth, but that's what point means. So when should you pay points? So a lot of people say, hey, I'd like to pay a couple of points because I don't like 6.5. I want to get an interest rate of 5.75, for example. Then you're going to have to pay points. But should you do it? It's really going to depend. And one of the most powerful tools that you can use to determine whether or not you should pay points is the amortization schedule. And the amortization schedule breaks down your payment into two parts. It shows how much is being applied to lower your loan balance. That's called the principal. And then it's taking the rest of it, and that gets applied to interest. That's the bank's interest. And an easy way to remember that, just kind of a funny way that I say it, is I have principals. I need to save money. So the principal goes to you. The bank is interested in making money, so they charge interest. So principal and interest. So the mistake that people usually make is they say, what's my payment going to be at 6.5? Your payment will be $2,000. Okay, what's my payment going to be at 5.75? And they say, okay, well, it's going to be $1,000. The difference of that seems like a really big difference, but when you pull an amortization schedule, you have to remove the principal portion because that's your money. That's reducing your loan balance. The reason you're paying points is to save the amount of money you're paying the bank to borrow the money, right? So I think inexperienced loan officers or people that just don't know, they're going to say, well, your payment would be this much, but it would be this much lower if you pay the 2 points. Yeah, that's true. But that doesn't mean you're saving that much because part of that payment is your principal. So what you have to do is you have to take out the interest portion and compare the two. Okay, at 6.5, my interest portion is this much. And at 5.75, my interest payment is this much. And whatever that difference is, you're going to calculate. I would maybe do 5 years. So 60 months. Say, okay, the difference between 6.5 and 5.75 is $300 a month. So 300 times 60 months, right? That's how much you're going to save. And then you have to look at the cost of the points. Are you going to break even on those points cost in 36 months? If you're not, then I would tell you just take the higher rate and don't worry about it. Now, some people might say, I don't care about the math. I just feel better having a lower payment. And that's fine. You can pay points. But from a mathematical standpoint, are you saving money? The best way to do it is to split it out, reduce the principal or eliminate the principal, focus on the interest. What's the difference between my interest at the higher rate with no points and the lower rate with points? And you really want to try to target about 36 months. If it's 36 months or less and you plan on staying in the property long term, then I would argue that that's probably money well spent. If you have any questions, you can always contact me. You can leave a comment in the section below. Hope you have a great day.